How are you? And Zodi Costanzo, clinical professor of economics and finance, St. Peter's in Jersey City, New Jersey. Part 2 of the Excel. So you saw your first Excel model yesterday. So let's just get right to it without all the soapboxing today. Let's get to that last problem we were working on last night and some of the other problems. And then we'll worry about appendix and comprehensive. We'll try to do it in pieces, not a big, long 5-hour video like I've been doing. We'll try to do it in pieces. So let's get to it. Okay, folks, here we are. All right, we start now. Again, I'm going to keep adding these to Blackboard. Okay, I'm going to continue to add these to Blackboard. Every time. Yeah, again, syllabus and schedule announcements. See, now you have 3 links. And actually, folks, what I'm going to try to do next time with this is just sort of try to get rid of some of the formatting jumble a little bit that we have. There's been a little some of the formatting on these were a little off from before, which I didn't like that. So yeah, so you have the 2 PowerPoints here, then you have the link for the first Excel, which is right there. What do we have here with these things? Yeah, Excel, one here. Yeah, PowerPoints are here. All the different Excels are going to be here. Yeah, here we go. Part 1. It's probably going to be part 3 with the Excel, and I'll add to that a little bit as we go along. But like I said, I'm going to just keep refreshing this and updating this. Okay, we'll go about an hour tonight just to get you guys a little further along. But like I said, how you need to do all this is you need to sit down with Excel and the video in front of you, and as the video's going along, you enter the Excel. You copy and paste the original. Hopefully you made maybe like another copy of the Excel file, and then you copy and paste the original, and then you keep mine for the sort of as a read-only. So last time we were working together, we talked about this loss, and we did the conversion from bonds, the shares, actually the bond instrument or the debt instrument, and to the equity instrument. We talked about that a bit last time. So now we have R&B here, and we're going to discuss that next. And actually, this we'll try to go 150, maybe a little bit better with the scaling. Maybe will help us a little bit better. We could use some help today, that's for sure. So anyway, $500,000 bond. You're redeeming that bond, so you're going to be cashing it, right, which is right there. 500,000, which is right here. You're retiring it at 102%, which is what you're doing. So 102% is going to be equal to this times the 500,000. That's the cash you're getting. Okay, that's the cash you're getting. Now there's a couple things going on here. Do we call the carrying value? Yeah, we call the carrying value at 508,000. Yeah, and here's simply what it is. It's this. It's face, bond, premium. Yeah, so this is 508.3. So obviously the premium is simply going to be the difference. All right, which is what that is. Okay, now in terms of the loss, you just got to keep in mind your book was 508. Okay, it says face value of the bond plus it's right, the bond at redemption, and then you received, or actually not you received, you pay to get rid to retire the liability. Yeah, this liability that you retired. To retire that, again, you may have done it early or something. So instead of paying 500,000, you paid 510, and whatever you may have had, whatever the interest on this was, a couple percent or whatever a couple interest payments were. It says, yeah, when you retire it at a higher percentage, you're generally retiring it earlier than was initially called for. It's that kind of that kind of a situation. So you're paying 510 when the face value was really 500. So you're paying off to cover lost interest payments. That's why a company would do something like this. So obviously now in terms of the loss of this, if on the books this was 508, your loss was simply the 510 minus sum parenthesis these two to equal sum parenthesis. Okay, that's it. That's your loss, was a $2,000 loss, because on your books it was 508, but you paid 510 to retire the liability. So you paid two. So you pulled out of your cash that amount, and it's this is 508 plus 2, which is what this is. That's 508 plus 2. Okay. Those are long-term notes payable, right? Short-term interest-bearing notes, except the term of the notes exceeds a year. Yeah. So this is like a short-term note. Mortgages are like this. Yeah, these are just some examples just from the textbook. I don't know why. I don't like to put the textbook examples in there like that. Yeah, McDonald's, 18% McDonald's related to mortgage notes on land. Yeah, business. Yeah. So again, a lot of their loans are real estate oriented loans. Adjustable. Actually, here this was a bit of a typo here. Adjustable rate. Okay, which is there. And this is adjustable rate right there. Whoops, it's got to be a space. I'm doing a little bookkeeping as I go along with this. This is the one I want you to be able to see. So, like I said, I took myself out, so I will know after this is done. But I try to do a spotlight on this, and I'm hoping the spotlight is the screen share, not me. So we'll see at the end of this how that all goes. Change the market interest rates, sure. Okay, unpaid back. Yeah. Now, again, I want to try to do like maybe one of these sort of bigger problems per video, so you just have a video at a time. This is the mortgage note, and it's a 20-year note. Porter Technology, yeah, Porter Technology, and 12%, 500,000, loan, 20 years to pay it off. Now, it was pre-computed in the sense, or in the problem in the tax rate, they said, okay, the installments are $33,231. That includes some principal and some interest. It's not like the bond where it's all interest payments and the principals at the end. It's not like that. Also, something just to keep in mind, we want you to be able to figure out the factor here. And there's a formula here that's not really in the accounting book. And if you see where it says C, that means the 6 month, are these semi-annual payments? I think they're semi-annual. We assumed it was semi-annual. 20 years, so 40. It's got to be 40 payments. Yeah, 40 payments. So these are semi-annual. So you can just see it over here. We're going to create a table like that. And again, we're just going to go sort of piece by piece through all this, okay, as we go along. So what do we have here? This is 12%. So the semi-annual is this divided by 2. The face value of the note, 500, 1, 2, 3. Is right there. The factor, well, let's say here, you're getting 5, so the present value of the annuity, you're getting 500,000. And then you're making 2 payments a year for, 20 years, 40 payments twice a year. So T is 40. C, you don't know. C is the 33, and then the present value is the 500,000. The rate, I think we use 6% for this. I think we use 6%. But here's what I did, though. So yeah, this was this issued at face? I think as long as if it's issued at face, I mean that's what it was bought for. Mortgage. Okay, semi-annual installment payments, 20 years. Yeah, we just made the assumption. It's just more. At face value. Yeah, it says up here. See, the top line says at face value. So you just use, this is the contractual, right? Annual contractual interest. But what we're going to say here is the following. This is going to be used as discount rate. right? That's used, and same thing here. Yeah, with this factor, I'm just going to say Control R to bring the formatting over. This factor is equal to 1 parenthesis 1 divided by 6% minus 1 divided by parenthesis 6 1 plus 6 exponent. It's 40. I'm going to put the 40 in, but we're going to use it from the bottom. Right there. That's the factor, just some sort of from the formula. And then what you'll do is you're going to say equals the present value divided by this. And there's your there's your 33,231, which is right here. But I also did it another way, probably a little the sort of the crazier way, maybe a little bit. Maybe you could say it the crazier way. And actually, with the periods, you know what? I'm going to do this just in the interest of time, right? Just for time interests. This is right there. That's the interest of time. There's 40 payments here, right? And went down to the bottom here. There's another one. Yeah, there's 40 payments at the end of this. Okay. Yeah, and you have to type in the dates, and you have to be a little sort of sophisticated to get all the dates typed in, as best you can. But yeah, so that's how you approach this. Okay, that's how you approach this. So this is equal to the 33, right? And actually, what we're going to do with this, I put the 40 in here. I'll tell you what I should have had. I should have had like a little counter that says how many years, and I should have had something like that, but I didn't do it like that. I did it like that later in the chapter. I didn't do it initially like that. But that's now another way to do it. Sort of a tougher way, but it's a way that I picked up. And yeah, you need a little stamina, but we're all about stamina. So I think we'll be all right with that. We're all about stamina. 1 plus this rate, we're going to lock that in, and then we're going to do we're going to do 40 of these, right? 40 of these. To again, whoops. See it's easy to mess up. Hang on. You're not there yet, but so looking at that, I put a bunch of these in. This will be, 63. Next one is 64. See, I'm 60, and you got to, you got to pile them in. The other thing is a little bit better. 67. Well, folks, complexity, complexity is what you need. This is complicated stuff. There's no two ways about it. This is all very complicated stuff. So where are we here with this thing? This was 71. 70. Okay. Here's 72. Here's 73. 74, 75, 76, 77, 78, 79, 80, right? We're getting there, 80. So we're like halfway there, right? We're like halfway there. 80, 81, 82, 83, 84, 85, 86. I think that's as far as we went with this. 86, up to 25. So we have a bunch more to do. We have another 15 to go. So copy 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. Okay, so yeah, so there you go. Hit return because that was a big, but obviously you're not, these are not all prepared yet. 82, 83, 84, 85, 86, 87, right? 88, 89, 90, 91, 92, 93. We're almost there. 94, 95, 96, 97, 98, 99, 100, almost. Yeah, there we go. See, it's the same. So we typed in 20 of these terms. Okay, I copy and pasted a bit. But again, that's the intensity of being, and you can see we have the same number here. So then if this is just equal to this divided by that, right? And it gives you, 33,000. And this is just simply all this. What happened here? Yeah, actually, this is not the first one. This is the first one. Okay, those are the cash payments that are made. Okay, so part of this is going to be interest payments, and a part is so again these, and actually you don't have you don't have the 100 or the 500,000 that's paid at the end. That you do not have. Equal sum parenthesis. That's the board. That's $1 million. So that adds up $33,000 payments. It's over $1.3 million. It is what that is. Okay. The initial balance. So the company, it was, it received its loan on the 31st. So I guess it was a happy new year for those guys, right? They received their loan on that date. Okay. And yeah, there's a couple things going on here. Contrary to the finance, look, I'm going to show you on the balance sheet how all this happens. So again, there's a $500,000 loan. There's $33,000, $231 payments. Okay, the loan is paid back in pieces over the 40 payments. So there's no once you make the last $33,000, $231 payment, that's it. But we're going to show you total liabilities, how all that happens in the textbook. Yeah, the next thing, the interest expense. See, these are the payments. Okay, this encompasses that whole 500,000 over all those years. So how are you going to pay that back over 40 payments and 46-month periods? That's what that is. This other piece is this. Actually, even better than that. Here times that 6%. And yeah, we're going to lock that row as it is because we're going to say copy Alt-H formula. And yeah, we don't, yeah. So looking at this, so what we're going to do is we've locked that percentage in. All right, we've locked that at line 49. We've locked that in as we go up and down. But what we're also going to do is the principal is going to ride first. So we have to have all the. I can't just do all these formulas. I mean, I can, but there. Alt-H formula. Okay. Yeah, there's nothing here that's going to get. There we go. That's that. Okay. So here we are with this 500,000, 6%. The reduction, the principal reduction is going to be as follows. You're going to take the payment minus the interest expense. Which is there. And this thing is, yeah, so obviously the next piece of this equals this minus this is all that. Okay. And see, now all of a sudden you have the next interest expense because the next interest expense corresponds to that principal balance. So we're going to clear this out and we're going to say these two formulas copy Alt-H formula. And see, then you have the next one, the 29, and so on. So here, let's just, and again, the book does just like a little snippet of this, but I'm trying to get you ready for the real world, and what the real world looks like. The real world looks like what we're talking about here. The total liability is just this principal at the end here. That's just the total liability. There's right there. The current liability is the next two interest payments. So the next two principal reductions. And then the longer term liability is the difference between those two. Okay, we're not looking at, again, this is just how the book defines current liabilities and long term liabilities. Okay, because if you look at what's going on here, you can sit there, scratch your head, and say, wait a second, I owe 33,000. How's my current liability only 7? Because it's only the principal reduction, it's what you're paying back. It doesn't include the interest expenses. Okay, on the balance sheet, just keep that in mind. Okay, so like I said, but the current we can't really get to that yet, so let's just hold on with that. So what you can do is you can take this whole sort of piece of this. So you're going to say, well, how do I do it? Yeah, like this. Copy. Alt-H formula. Yeah, and you can see you're right away. You went to 0, right there, right? And we're going to fill this in. Right, and all these other pieces, copy, paste. These are all the total liabilities. Those are all the total liabilities that we're looking at. Okay, the 60. Yeah, this one didn't need. That didn't need any border. Right, that didn't need a border. But those are all the total liabilities. Okay, so like I said, this is right because you end up at 0. So what happens is, and here, let's just follow me through this. You have a $500,000 loan. You agree to make 40 payments at $33,231 over 20 years. We have all the dates here. It's June and December. We are very easy to keep that in mind. This is the issuance date, which is that first date right there. This was issued at face value, so your discount rate is your semi-annual interest rate. That's generally not the case, but in this example, for this mortgage installment payment situation, it is. Okay, so you make all these payments. Some of it is interest expense, and some of it is principal. And again, let's figure out how that happens. Well, based on the principal, you're doing 6% of this, so that's a lot of interest there. And then what's left of this is pays off the principal. Now, with a little principal paid off, your next principal is the 500,000 minus the principal reduction, which is 496, and then 493, 489, 45, 41, 477. You keep paying, so you keep taking 6% of a smaller number. 6% of a smaller number increases. Yeah, right, because it's the same cash payment here is what you're doing. So right, the 6% of these numbers, right? So exactly 6% of a smaller number, the interest expense is going to decline here. And then as the interest declines, when you're making the same cash payment, your principal reduction goes up. So you're paying more principal as you go deeper into the loan payments is really what you're doing. Okay. So what's next? What's next is this is the next two principal reductions is what this is. That's the current liability. So it's the sum of the next two of them in 2014. Yeah. Yeah, 26,947. Yeah, actually here there's nothing. I'm just going to put a 0 in as is. We're not, we're not trying to identify, we're not trying to identify with stuff that doesn't have a. It doesn't have values in it. Yeah, 0. Okay. And this is this minus that. Yep, that's it. Okay, so we got this. Again, this is what the balance sheet looks like. Again, let's review, sort of what we're doing here. Total liability is at the end of the calendar, the fiscal year, the calendar year, what principal balance do you owe? Okay. Long term is the difference between the current and the total, and the current is the principal reduction for the next year. So you're at December 13 here, but you're looking to reduce current liabilities in 2014, about whatever that is, 7,478. Okay. That's how you, and like I said, so here's the formula here. It's just equal to that. This formula is just those two added up, and this formula is the difference here. It's the total liability minus the current. Okay. There's that formula, this formula, and this is just, again, this is just the interest expense. Every balance that is reduced, this is going to be it's 6%, but of a smaller number. Okay. So that's your amortization table, is what this is. This is your amortization table. Okay. Yeah, so we have another one of these that I'm looking at here, bond versus note. I think we're going to hit the leases, and I don't want to just do two in the same video. You know, I want to break it up where we sort of do this again. You know, let this ferment a little bit, and we sort of do this thing again. So let's get this thing taken care of. This is just for like the first. This is just for the first piece of this. Okay, this is what? Okay, this is the, yeah, this records the mortgage loan. So the payable is 500,000. Okay, so we're here. So 500,000 on that is where that is. This is on the 31st. This is on the issuance date. And actually what you could do, you could probably just set these dates equal to one another too. So there's a link. Or either way, right? Actually, it should have been the reverse, but it'll work for this. And then the first interest payment, yeah, this is just, you know, what happens on June 30th, right? What happens on June 30th is you have 30,000. $3,231, and this is 33,220 or 230. Pardon me. AL62, AL62, delete, and we'll do underline here. Copy, paste, italics, smaller equals do a check. Yeah. Okay. This records a semi-annual payment is what this is. Okay. So in here, let's just, again, this, you'll obviously have 40 of these, right? Right, you'll have 40 of these things. You're right here. Interest expense, reduction. There's no principal balance here, but then this, obviously this piece comes here. Okay. So the total liability is 493, which is right there. $334, and then what's current and what's long term. Right, these are the current and long term, 478 and 45. Actually. So how are you? So there you go. Okay, and this just says it in words. You could say, we didn't say this 40 times, but that's why the table, you know, is what we like. And actually looking at these other arrows here, we're checking here, and we're saying, okay, you know, the principal balance at the end of the year, that was whatever this was. That was, you know, the long-term liability is whatever this is every time. So the long-term liability, you know, beyond the next year kind of a thing. So looking at this is, yeah, the current liability is the 26 and the 27,000, but the longer term liability is the 60, because the 60 is here. That's your balance at the end of the year, but obviously this is just simply these two, right? So if you're looking at that, and this is, yeah, that 6 is just simply those two. Again, you have to look at the years, how the years change. Okay. Well, this is complicated. Nobody's saying this was easy, folks. Nobody's saying, but again, you have the video, you have the mod. Just make the entries yourself as you go. Make sure you, and just, you can rewatch this as many times as you need to. I don't want to do another one of these because there's another one down here. Okay, there's another. So we're going to wait on this. You know, I'm going to keep going in the video, but we're going to come back to this, like probably, you know, the next video, whenever the next video is. We're going to come back to this. Is cold research. It's the same type of so we'll do this in another video. It's the journal entries and things of that nature. Bond versus note. Notes are single lender. Bonds can have a bunch of lenders. You know, they're borrowing from small investing units, kind of a thing. And yeah, so look, as interest rates move around, now it gets into little economics. As interest rates move around, are people taking more loans because there's lower interest? You know, that kind of a thing. Is there more activity in the bond market? Is there more activity in the equity market? Well, when interest rates are lower, then the capital is going to chase a better return theoretically in equity. You know, those kinds of conversations. Okay, so that's really what that is. You know, bond financing versus short-term financing, bond versus note. And again, you guys can read all this. If the banks aren't lending, you might go to like a hedge fund, or you might go to somebody else to get another avenue outside of the bank but everybody sort of has their own credit sort of rating system, so you're still being evaluated for how much what the chances of you paying this back are. You're still being evaluated on that, so never think you're going to really get away from that. That's a little deceptive one. Yeah, this is the mortgage thing. We're going to do that the next video. So renting of an apartment, renting of a car at the airport are examples of operating leases. So yeah, so this is just simply you're doing a car rental transaction. It's an expense, you pay for it. You know, you get the benefit. You're using the asset, but the owner still have the benefit and the risks of owning it. You're just using it. So all that's just 275 and 275. Those are just entries. Okay, and we had this discussion, I think, in the PowerPoints. Capital leases, that's a little more complicated. Is there a bargain purchase option? Is 75 more the economic life used by the leased property? Is a present value equal to or exceeds 90% of the fair market value? There's all these conditions here. The lease transfers ownership of the property to the lessee type thing, and then there's all sorts of rationale. The lease term the lease lessee receives ownership of the asset. The lessee should report the lease as an asset on its books. So yeah, so if you're eventually going to own this thing, that's really what it's saying. If during the term of the lease, the lessee can purchase the asset at a price that is below its market value, the lease will exercise this option to report this as an asset. This is all the reasons why you have a capital lease. Okay, and like I said, and this other one here, this is just another one of those examples. This is the whole capital lease example here, and we have the definition of it. Although legally a rental case, and it is in substance an installment purchase by the lessee, accounting standards require the substance over form be used in such a situation. That's all well and good. So, and again, what that looks like is here. So whatever this thing was, where's the example? The equipment is 190,000. I'm trying to find out where that was, where the example was. So pardon me while I do that. It's not here, unless that was just an example in the book. To record lease asset and lease liability. Okay. Oh, here it is. Yeah, it decides to lease new equipment. It's for 4 years. Lease equipment is estimated to be 5 years. The present value of the payments are 190,000, so which is equal to the fair market value. So there you go. It's going to be bigger than 75% of the. If you're using it for 4 of the 5 years, it's bigger than 75% of the estimated life and all that. So this gives all the conditions. They're purchasing the equipment. Conditions 3 and 4 have been met. The lease term is 75% or more of the economic life of the asset. The second, the present value of the cash amount is equal to the equipment's fair market value. Gonzalez records the transaction as false. So you're entering 2 190s is what you're entering. Off-balance sheet financing, lessee reports a leased asset on the balance sheet under plant assets. If it reports lease liability on the balance sheet as liability, the portion of lease liability expected to be paid next year is current liability. The remainder is classified as more. Yeah, this is the exact same conversation that we had before. Off-balance sheet financing is because liabilities increase the company's total liability. So to take those sort of off your books, they can do off. But this is Enron got in a lot of trouble by doing this. So yeah, this is more of the sort of the legal avenue of things where, you know, it mentions this in the book, but we don't really have an example on that. So, but you're just not showing this under your total liabilities for better or worse. But like I said, folks, we have this other problem that we're going to work on in the next video. Yeah, let's look at, since we're here, yeah, let's look at statement presentation. Yeah, let's look at, and then we'll again, so the next time that we're going to get together, it'll be the comprehensive problem and that other, actually this is got a mortgage thing too. So yeah, we might just do that one just sort of as a standalone or something, because like I said, I want to break these videos up a bit. The comprehensive problem is sort of substantial. So anyway, how you present this, there's a long-term liability section in the balance sheet. Present summary data in the balance sheet. Report the current maturities, long-term debt under current liabilities if they're paid from current assets. Long-run solvency, you know, measuring that. Repay the face value of the debt at maturity, debt paying ability, long-run solvency. So yeah, so you're looking, right, these are some ratios. We're going to discuss some ratios here. Total debt divided by total assets type thing. Again, obviously, if debt to assets is bigger than 1, and this, you know, that's obviously, then you're insolvent. If you got more debt than the assets, especially assets you can liquidate, then that's certainly a problem. And that's measured by creditors. And worse times, that's measured a little bit more than it generally is. I mean, in tighter economic times, you know, we care about that a little bit more. So. Okay. Times interest ratio indicates the company's ability to meet interest payments as they come due, dividing income before income tax and interest expense by interest expense. Okay. You always underline the company in this stuff. Did we have that last time with this other thing? With the Gonzalez company, whatever it was. Coal, we're going to get to next time. Western. Okay, Gonzalez was underlined, okay. You're leasing equipment or new equipment. And there, B is right, that's Gonzalez. So yeah, there's the debt to assets ratio, and there's income before taxes and interest expense divided by interest expense. Okay, and now look, generally you're gonna have to go searching for all of those. You know, you're gonna have to look for all that information. Okay, you have to, but here we sort of have it for you, just sort of given to you. But you have to search through the SEC documents. And so this is in millions, and we're gonna say total assets are 11,200,000,000. Right, that's 11,200. All right, this is 8920. This is 295. Interest expense 295 million, 476 million. 1,208,000 is right there. So debt to assets is all the liabilities divided by all the assets. About 80%, right? About 80%, so equals this. Let's do a percentage of this. I should have had that before, worked out before. We only need 1 decimal place. Center, yeah. All right, that's that. And this is usually times. This is usually times. So this is going to be this minus taxes minus interest, parenthesis home, parenthesis n, divided by interest expense. Did I get that right? Oh, pardon. We have to add these back. Yeah, these are all add backs. I subtracted them. There they go. My fault. So what this means is Before interest expense and taxes, you have 6.7 times the amount of money that you need to cover your interest. So you could cover that interest expense 6.5 times or 6.7 times. Okay, that's really what that means. Okay. So we showed you that one. I mean, I could wait on this one, but here, let's just sort of finish this sort of column out here. This is the capital lease again. This is another capital lease problem. And this is what you care about. You care about the present value of the lease payments. So you prepare and actually record the leases, transfers ownership to FX at the end of the lease period. Again, what the assets the company has, what the stockholders' equity is, what the liability, obviously equity and liability have to have equal assets. This is 240, 1, 2, 3, 240, 1, 2, 3. Okay, so so this is 2 million. Yeah, 1, 2, 0, 0, 1, 2, 3. All right, and this, we're just going to add these two together. Okay, that's total assets and equity and liability added up, 2 million. Okay, is that? And this is just simply debt divided by assets, okay, which is 0.6. Which is that. So 60% of the total assets were provided by creditors, is really what that means. Okay. Liquidity is how easily you can convert something into cash. Solvency is, do you have enough assets to cover your debt? If you're insolvent, that means your debt exceeds your assets that you can sell to cover the debt. That's really what that means. And like I said, this stuff has got to be measured. Again, the sort of the more unknown your reputation is, or maybe the worse your credit reputation is as a company or entity or a trading platform, the more this is going to be monitored by whoever lends you money. And if it's done privately, it's whatever the private folks want. You know, there's no federal law or state laws that say, hey, it should be this, it should be that. Now, sure, states borrow, municipalities borrow, and there's all sorts of infrastructure for that. But when it's just private, my experience is all in private lending. It's whatever the private lenders sort of say. That's sort of how that all works. Okay. So yes, you had some examples today that you guys could look at. This comprehensive problem is kind of long, and we're going to get to this next time. And also there's a mortgage installment payment in there. And like I said, this other one here, I don't want to just do two of the exact same thing. Let's let this ferment a little bit. You already saw this example, so we're going to come back to this next time. So yeah, so this is only an hour or so. This is probably just like a little bit short, a little bit of a shorter video. But like I said, at least you have some things you could see here to give a try to. Okay, like I said, I'm interested to see if we tried a new format with the YouTube, with the Google Meet, and we'll see sort of how that all turned out. Okay. Okay, folks. Okay, folks. Be well. Have as good of a holiday as you can. Be tough over the next 6 months or so, next 6, 7 months. It's going to be a little bit of a challenge, emotional challenge for all of us, myself included. But you guys are going to be fine. I'm with you. Always drop me an email about how you're doing. In any way. I'm always happy to talk to you guys about that. And it's always great spending time with you. And then tomorrow we'll have another video. Okay. All right. We'll see you soon.